partner with Rev Birmingham to present on cash flow forecasting today. The Women's Business Center is located in Nashville, Tennessee, and we are dedicated to serving our women entrepreneurs in Tennessee through educational resources, mentoring, and encouragement. And just thank you so much for this opportunity to be here. And Catherine is going to start us off with planning. So I will stop sharing my screen.
Okay. All right. So why do we want to bother planning? So unfortunately, faith is not a plan. Luck, neither, not a plan. You can't take those things to the bank. Faith and luck are extremely important and the foundation for many of our successes, but they are not a plan. It is not the same thing. Planning is a mental muscle, and it's something that you practice and can get better at. You build it, you work at it, and you will get better at planning. Preparation plus opportunity, many of you will have heard this, equals success. So when you have, if you don't plan or if you don't prepare, you're preparing to fail. The opposite of that, preparation plus opportunity, will lead you to success. So what are we planning for, right? Obviously, we want to plan for good times and bad times, but we also want to plan for changing opportunities. So good times can include hiring employees. If you get a big government contract, or you're building out a second store, or you're just moving from cottage food into a commercial kitchen and you need a second pair of hands. Those are all opportunities for you to really plan out what that's going to mean for your company. If you're going to invest in new technology, say you're a retailer right now and your store has been on and off shut down, you're negotiating with your landlord to continue paying rent or get out of your lease early. Maybe you want to pivot to e-commerce and see what that is like. Investing in technology, that's something that you can plan for. Giving yourself a bonus, heck yeah, right? Like that's what we want to do in business. We want to pay ourselves. So giving yourself a bonus, if you plan, you can do that. Bad times, of course, COVID, it's a buzzword these days. It's thrown us all off, right? And again, I'm going to go back to that, building that muscle, right? So when you think of exercising and you're in the gym or you're in your, you're at your home gym, you're lifting weights to build those muscles. What are those muscles for, right? Yes, you're using them to lift weights when you're exercising, but in the real world, you're using them to pick up your kids or pick up groceries or move your household or move supplies for your business, right? And the same can be thought about this mental muscle of planning, is that once you develop that planning skill and that planning muscle in your brain, you can really use that in a diverse set of situations. So once you have that experience, that really sets you up for a higher level of success. So bad times obviously include COVID and business interruption. Changing opportunities. So business financing, that's a changing opportunities. And I put this under changing opportunities rather than good times or bad, because you may need financing for good things or bad, right? So grants and loans, knowing what you need them for and how much to ask for, that is something that you need to understand the plan for your business for. Changing consumer sentiments, pivoting to new products and services. Those are all things to plan for. And then how do we plan? So we want to benchmark and observe, then we want to choose a template, and we want to work with pros, because planning is really best done working with other people. I come from a collaborative mindset, so that is how I like to start projects and work them through. If that's not you, start it, however you like to start things, just get it started. And then bring experts in as you need them and when you get stuck. So those experts are your banker, accountant, lawyer, mentor, SBDC advisor, and any of the Rebound Birmingham partners. We all have our niches and our specializations. So at that point, if you have any questions, feel free to drop it in the chat, but I'm going to turn it back over to Jalicia to take over the exciting portion of cash flow and statements. Woo!
Cash flow forecasting, which is definitely a strategic tool to help you plan for your business. So let me make this pretty again. There we go. So, good morning again, everyone. Let's just dive right into cash flow forecasting. And so, our objectives for today will be reviewing financial statements, looking at the cash flow budgeting, and then providing you additional resources for you to use going forward. So I'm an accountant by trade and accountant at heart, and think and know that financial statements are so important as you begin planning and preparing for your business, because it provides insight into how your company has performed historically, and that provides insight on how your company can perform going forward. So we're going to start with the income statement. So the income statement is broken down into these segments: revenue, operating expenses, other income, to give you your net income. So your income is basically the money you generate from selling your product or providing your service. Your cost of goods sold is the cost of creating that product or creating that service. So my prime example is, a cookie shop. Well, what are the ingredients it takes for you to produce those cookies? Flour, butter, sugar, milk, eggs, etc. And then the operating expense. If you have a brick and mortar location, well, you have to pay for your rent, you have to pay for advertising, you pay for insurance, you have to pay for payroll and your staff. So those are your operating expenses. And then there's other income. So in all businesses, you'll have some income and expenses that are not directly related to your business, and those are also reflected on your income statement. And whatever you have left over is your net income or net loss. And I know I'm going fast, but there is a financial lingo class later today that will go into a deeper dive, but this is just an introduction because it's going to lead you into cash flow forecasting. And I think it's just a great basis to start with. So these are a couple of examples of what an income statement look like using Excel. And so here, where you see revenue and COGS at the top portion, like I mentioned before, it's your gross sales. So from selling your product, your cost of goods sold, the material and direct labor to give you your gross profit. And then at the lower portion of that are your overhead expenses, all the expenses it takes for you to run your business. And we all want to be in that green bubble, not that red. Green means you're making money, red, you're in a loss, or you can break even. A lot of business owners in the beginning, the whole goal is to break even. You're not losing any money. So this is a rolling 12-month financial statement or income statement. And the reason I like to look at these in totality is because you can determine trends within your business. So for instance, an ice cream shop. An ice cream shop will do very well in summer months. So between May through September, you're probably operating at your highest peak. But fall, winter, you may not. And so this gives you the insight to how your business will perform over the entire year. So your business may have what is called seasonality, where you perform better in the summer months, but not so well in the winter months. And so that helps you determine, what do I need to do going forward? And that is looking at your cash flow statement. So we're building, guys, we're building. So next is your balance sheet. Your balance sheet are the assets and liabilities and equity of your company. So assets are essentially what you own: bank cash in the bank, accounts receivable, if people owe you any money. Prepaid assets. A prepaid asset is, for instance, you pay for insurance for 12 months out the year, you go ahead and pay that $800. Well, prepaid assets are, okay, I paid for this service, but I haven't received it yet. Any inventory, your machinery, your equipment, your fixed assets. Liabilities, those are what you owe. And so liabilities could be current bills that are coming up, credit card payments, any debt that you owe if you've taken out a loan. And then equity is essentially what either you have invested in the company, or if you have outside investors, it's reflected there. If you're taking owner draws, it'll be listed in the equity section of your financials. So let's keep going. So this is what a financial statement or a balance sheet looks like in an Excel document. So you have all of your assets, you have all of your liabilities. The accounting equation is assets minus liabilities equal equity. And not to scare you, but with math, you can write a math equation in multiple ways, as you can see on the left portion of the screen.
Shirley,
So I'm going to pause there.
Can I ask a question?
For any questions. Do we have a question, Catherine?
Yeah, I'm going to jump in here. I've got two questions that I frequently get, and one that I just don't understand. Why
Okay.
does equity appear on the balance sheet under liabilities? Is it considered a liability? And
It is not considered a liability.
okay.
So equity is its own portion of the balance sheet. And so there, as we can see on this screen, and hopefully you can see me pointing here.
Hmm.
So equity consists of your opening balance. So that rolls over from prior year, prior month. As we can see, it hasn't changed on this balance sheet. And then owner's draw. So if you're taking owner's draw, that's essentially the owner paying themselves. And then retained earnings, which is also rolled over from prior year as well. And then net income comes directly from the income sheet at the end of the year. And so that'll change every month or so. So for instance, the opening balance from December was 10,000, but then the income you can see reflected decrease to $2,000 in January. And so that's rolling and changing as that income is changing.
Awesome. Thank you. My second question is, what is the big difference between the cash flow, income, and balance sheets, and how do you use them together?
Yes, so we are moving in that direction.
Awesome.
Um, so essentially, I'll go ahead and give you a preview of that answer, but we'll definitely dive in deeper. So essentially, a cash flow statement is the combination of your income statement and your balance sheet, because your income statement reflects current expenses to operate your business. The balance sheet provides intel specifically on the liability portions of the debt you pay. And so, for instance, let's say you go to the bank and take out a loan of $10,000. Well, when you go to the bank, they're going to charge you interest, right? They're just not going to say, "Here, pay me back the 10,000." It's 10,000 plus 3% because the bank has to make money as well. And so when you record that debt, it is on your balance sheet as a $10,000. But when you make those monthly payments, a portion of that is to principal, and then a portion of that is to interest. The principal portion is reflected on the balance sheet to decrease the loan balance, but the interest is on the income statement because it is an expense of your company. And so what we're doing is we're taking that income statement and that balance sheet and merging it. So you do this every day. For instance, you create cash flow statements probably personally every day. So for instance, let me not go too fast. So for instance, let's say you're on salary and you make $1,500 per week and you're paid bi-weekly. So you make $3,000 every week. So in 1 month, you make $6,000. And you go through and you say, what are my monthly expenses? $1,000 for rent, $1,000 for my car, $1,000 for this. And at the end, you see what you have left over. And let's say you have $1,000. That's great. You have a net profit, right? But let's say, for instance, 1 month, something unexpected happens and it costs you $1,500. Well, on average, you have $1,000 left over, but now you have a $500 deficit or a negative, and you need to come up with $500. Well, looking and knowing that you need $500, you can plan it appropriately. Do I take on a side job to generate $500? Do I go to the bank and take out a loan? Looking at your cash flow, you determine, can I afford to make those loan payments? Do I go to a family member for the additional 500? So essentially, we're merging the income statement and the balance sheet to create what does my cash flow look like over a certain period of time. Does that help, Catherine? Am I by myself?
Nope, sorry, I just unmuting myself. That is
Okay.
awesome. Thank you so much.
Okay. So I gave you guys a preview, of the cash flow statement with Catherine's amazing questions. And let me show you how these two are being merged. So with the cash flow statement, it's really just the flow of funds coming into your account and the funds that are going out. And so really just plus and minus. So cash in the bank comes from you generating sales. You own your cookie shop, you're selling cookies. So that is money coming into your account, and that's reflected on the income statement. capital contributed. You have investors. You've personally invested money into your account. That is reflected on the balance sheet in that equity section we talked about. Loan proceeds. When you get $10,000 from Pathway Lending, that is reflected in your cash. That's cash coming into the bank. And so you gather all of that material together and identify, this is on average, or this is how much I expect to have as actual funds. So that's the biggest difference. A lot of people, if you, if you're not a cash-based company and you allow people to pay within 30 days, that's not cash in the bank. You don't receive that today. You'll have to wait for 30 days until you actually have that money in the bank to spend it. So cash out the bank, what are you paying for? So the direct cost for your product, the material it takes for you to purchase the flour, the sugar, the chips, the dough, that is material cost. How you pay your employees, that's direct labor. If you're paying yourself, that also is money coming out the bank. That's your owner's draw, which is reflected on a balance sheet. Operating the business, I encourage you, if you don't have an accounting system, to pay for QuickBooks, advertising your business, if you have rent, if you have insurance. Everyone should have insurance for their business. That's money coming out the bank. You're making those payments monthly or whatever process you have. And then loan and debt payments. We just talked about this. So when you make your debt payment, a portion of that, the principal, is on the balance sheet, but the interest is on the income statement. And then capital expenditures, for instance, you want to purchase machinery or equipment or get more inventory. All of that's reflected on the balance sheet in that asset section. So do we have any questions? I want to pause here because we've gone through a lot. We're going to go into a deeper dive into cash flow forecasting. So I wanted to take a minute to pause here. Do we have any questions?
If you're camera shy or if you're voice shy, feel free to drop it in the chat. Otherwise, feel free to unmute yourself and go ahead and ask us any questions. This is a safe space. There are no dumb questions, and we are covering sort of a middle level of information here. So if you have, if you're expecting to or want to start a business, if you're 10 years into your business and considering how to take on government contracting, those are all good kinds of questions that we can answer. And if your brain is moving at 1,000 miles an hour and you're just totally overwhelmed, please remember that we are all here to support you, and our information will be at the end of the presentation so that you can reach out to us directly for one-on-one coaching and mentoring.
Yes, thank you so much, Catherine, for that. This is definitely a safe space. Just to let you guys know, I'm an accountant by trade. That's what my degree is in. And honestly, it took me a while to understand this too. And it's almost like a light bulb, like, oh, click, click, click. So we're definitely here to support you along the way. So I'm going to keep going. Feel free to drop your questions in the chat function or email me afterwards. So let me reiterate that the purpose of cash flow is the movement of funds in and out of the business from the cash you receive for selling your product, your service, loan proceeds, or capital you receive from investors, or what you put into the business. And with these funds, you pay expenses to keep the business running. So after paying all your bills and you have money left over, you're profitable. That's really good. But if you don't have any cash left over, you're at break even. And if you spent more than what you received, you're at a loss. So these are all the funds that are coming in. And what's coming out is your debt payments, your indirect costs, and then your direct costs. So the overall purpose of cash flow forecasting is to help you make strategic decisions for your company. It's all about strategizing, planning, and preparing. It allows you to run various scenarios based on different assumptions. Currently, many businesses are not generating revenue due to COVID, if I'm just being honest. And so through this exercise, it'll allow you to identify the total amount of expenses you have per month. And so then you can determine how much cash you need to continue operating your business. And so it's that obtaining financial goals, it's the estimating funds you need. It helps you identify, would I buy versus rent? Do I have enough cash to support a loan to purchase equipment? Do I have the ability to hire additional assistants? Catherine mentioned, do I have enough to increase my pay as an owner or pay out bonuses? So this is really a strategic tool to help determine how your company, or how do you expect your company to perform over a period of time. So the approach at Pathway that we like to teach is the bottom-up approach. And so with the bottom-up approach, we're determining all of the expenses your company has, all the expenditures, everything you're going to pay out for your business, and then determining your sales. And so I mentioned earlier that this is coming from your financial statements, but if you do not have financial statements prepared, I don't want you to be afraid, because you can go to your bank statements and look at, every month, oh, I have rent, I have insurance, I pay myself, I pay my employees. And so you can go through your payments, but this is my pause to get on my soapbox. First, if you don't have financial statements, I would like for you to ensure that you have a business bank account that is separate from your personal, and you are not commingling funds. That's step one. Step two, I highly encourage that you do get a financial system in place, or an accounting system in place, or hire an accountant, because that information is imperative. And if you don't have it, don't worry, because Rev Birmingham and I will be teaching a QuickBooks deep dive August 27th. So make sure you go and register for that course. So back to cash flow budgeting and the bottom-up approach. So first, we're going to start with owner's draw. What do you pay yourself? What are your goals? What is your lifestyle? A lot of times business owners don't pay themselves. And I ask, how are you living? It's great to have a business, but you need to be able to survive from that business if that's your full-time employment. Next are your debt payments. Do you have any loans? You're obligated to pay that banking institution every month, and that reflects on your business credit. So how much do you have to pay? That's principal and interest every month. And with everything that's happened with COVID, I know a lot of banks have allowed people to defer payments. And if you need that deferral, just be open and transparent with your banking institution. Next, you have any equipment you would like to purchase, and just wondering, how are you going to pay for that equipment? Would it be through debt payments? Is it, asking an owner or a further investor to purchase that asset for you? So those are the three. So owner's draw, debt payments, and then equipment purchases. Next, we have indirect costs. So these are directly related to running your business. It's not related to producing your product or your services. So like I mentioned, fixed expenses are costs that don't change per month. For instance, your rent. If you have a rent agreement of $1,000 per month, 1,000 is such an easy number to use, but you're obligated to pay that regardless if you sell 500 cookies or 2 cookies. That does not change. And another thing, I know a lot of people aren't able to pay their rent right now. So definitely talk to your landlord and create an adjustment if you need to. And then periodic payments are payments that are not reoccurring, but you expect to have to pay it. Like, these are just what you have to pay. So for instance, insurance or tax payments, periodic payments, so things that you expect you would have to pay in your business. So right now with the bottom-up approach, what we're doing is totaling all the costs for your business. So that's the bottom piece. Now the next piece is cost of goods sold. I want to start there because that's an additional cost of your business, but it's directly related to your revenue. So we'll pause here. Fixed expenses don't change, but cost of goods vary directly with your sales or revenue. So for instance, it costs 50 cents to sell 1 cookie, right? It costs you 50 cents. So every time you increase how many cookies do you make, your cost of good increases as well for your material. Your direct labor, for instance, your hourly employees, that's directly related to how long your business is open. And then at the top is your sales revenue. What do you expect to sell over a period of time? And that's being very realistic. So why I think having your financial statements prepared is imperative is because you can look at the historical data and know how your company historically performs. So for instance, though we're living in very different range from 2019, it gives you a starting place. So for instance, in July, you normally do extremely well because we're going back to that ice cream shop and your sales normally is $20,000. Well, that's your starting point. If we were in a world that wasn't going through a pandemic, that could be your starting point. You can say, well, this time last year, I know that I generated $20,000 in revenue, but I've also extended my hours this month and I've hired additional employees and introduced different ice cream flavors. So I can project that my sales will be 25,000, but we're not in that world or time frame right now. So I know in Tennessee, and specifically in the Nashville area, we're at 50% capacity. So you can't have more than 50% of customer or clients in your space at a certain period of time. We've gone through periods where restaurants have to be closed and to get all that into account. So you can say July 2019, I had $20,000 in revenue, but we're going through a pandemic and I am not operating in the same time frame, or I'm not operating in the same sense. So you can take, well, we're only operating, or we can be at 50% capacity. So boom, I can slash that to 10,000. And then the next piece is I haven't really noticed that many people coming into the ice cream shop. Let me reduce that by 20%. And so now you're down to $8,000. And that allows you to take how much you think from sales revenue is coming into your business, minus all that cost, to determine what do you have left over per month. If you are positive, that's great. But if you're negative, and I'm speaking specifically to the time frame of being in COVID, this is your opportunity to identify, do I need more idle funding? When I was need to go to a banking institution to get some type of rapid relief funding so I can continue my operations. So this is what I'm saying is such an important and strategic tool. So let's look at an example of a 12-month cash flow projection. And so remember, we're doing the bottom-up approach. So we're not starting here with product sales. We're starting at the bottom with owner's draw. So just being able to read this chart, owner's draw, this owner's taking out $1,500 per month for a total of $18,000 over the year. Loan payments. So they're paying $250 over the course of the year. Equipment purchases. So in October, they decided to purchase equipment of $5,000. So we have total cash flow of April, starting in April, of $1,750. See there? All right. I jumped too fast. Now looking at indirect costs. So this was created this year. And so let's look and see. So website hosting and maintenance. So probably previously they had a website and they had someone taking care of it, but due to COVID, they couldn't afford it. So they deferred that payment. Laundry service, they deferred it. Cell phone, internet, that's important. So they continue making those payments. But as far as office subscriptions, salaries, wages, repairs and maintenance, rent, they deferred their rent for a while, still paid their electricity, didn't have any automobile expenses because they probably weren't operating. Marketing, advertising, you're still in business, still want to get your brand, your naming out there, so they still paid that. But we can see that they decreased it by 50% because in June it increased back to 200. Insurance, they weren't paying their insurance, but you can tell here, looking at financial statements, they paid $5,000 in September. So it seems like to me that they pay that annually for over a 12-month period. Freight and postage, $0. They weren't really operating in April or May, but in June, they started back operating. Still paid that accountant. And then going up to their cost of goods sold. And so they were operating, it seems like their service was 50% and then their product was 25%. So they were primarily providing products for April and then started back paying, they were primarily providing services for April. And then they started back providing products May going forward. And then from product sales, We can see here they did not have any product sales, but they did have some services. And so starting back from the bottom up approach, you can see that their beginning bank balance was $35,000. But in April, they were operating in a deficit. The total cash requirements was $1,750. But luckily, they had this $35,000 in the bank to cover that expense. In May, they broke even, so their bank balance stayed the same. In June, they only generated, let's see. In June, their gross margin was $2,250, but their total indirect cost was $5,000. So they did not generate enough income on their own to cover their operating expenses, those indirect expenses. And then they had other cash requirements of $1,750. So they were in a deficit of $4,500. But luckily they had cash in the bank. If they did not have cash in the bank, this will be a conversation to what do I need to do to ensure that my business still stays operating. So being able to create a 12-month forecast, knowing what all of your costs are and realistically determining your sales helps you plan going forward. It helps you determine the amount of cash you could potentially have on hand. Another reason why this is so important is because it's always important to have sales goals. Even for yourself, for your staff, you need to know what, you need to have a motivator. What is the amount you're pushing to for that particular month? So what I tell my clients to do all the time is to have their budgeted projection and at the end of the month compare it to their actual, because that gives you a mind frame. Do I truly understand how my company is operating? So if you look in this last column here in March, they have a total sales goal of $25,000. This is what they're projecting. This is what they're hoping they would do. So March 2021, I would say April 1st, they should gather their bank statement, look at their total sales, or look at their financial statements if they have them, look at their total sales, look at their cost of goods sold, look at all of the costs of their company and apply the budgeted to the actual. And if you are within 10% off, you need to go back to your cash flow projections and adjust it because it shouldn't be that off. And it lets you know if you truly understand how your business is operating. So I've just talked a lot there. I'm going to pause for any questions. How about this in the chat function? Let me know if you have financial statements prepared, A, and B, if you've ever created cash flow projections. Can we do that? This is a no judgment zone, so let me know. We have quite a few participants, so if you don't have any, just say I don't have any right now, or if you're interested. Thank you so much, Wanda, for sharing. All right, Tammy, great. Tammy, have you created a cash flow statement before? And part of that, I've never done a cash flow projections because I never understood it, but you explained it so well. I would do it now. Great, great, Ms. Smith. And so another piece of that, when I mentioned comparing your budgeted to your actuals, is you're looking at your financial statements. You're reading it, you're understanding it, you're knowing how your company is performing. I just gave you one way to identify your sales goals, but Catherine is going to follow up momentarily to talk about assumptions and benchmarking against others in your industry and to know how your industry is performing. Mary Alice created a cash flow statement before, but it was a long time ago. Mary Alice, that's great, and I'm glad that you have that acumen to create them, and I would encourage you to create them, especially during this time, because there's so much uncertainty, but in uncertainty, you can find comfort in planning and preparing. I experienced so many clients who weren't able to receive the EIDL or the PPP or even landing a Pathway, because with Pathway, one of our requirements is being able to project 3 months out. How much do you think you'll need? And the only way you can do that is looking at your cash flow statement. And like I said, you guys probably do it all the time with your personal budget. Definitely do it with your business budget as well, and just starting to implement those good habits of understanding the cash flow of your company, the cycle of your company, if there's any seasonality. So thank you all so much for sharing. And next, I would just like to provide a couple of resources that Pathway highly encourage our clients to use. So we definitely love QuickBooks at Pathway. It's very, I would say it's user friendly. And what I like most about QuickBooks is that there is a community. So once you log in, join your account, I use it all the time. If you have specific accounting questions, if you don't understand how to use the functionality of QuickBooks, there is a resource. So Mary Alice asks, is QuickBooks free? QuickBooks is not free. There is a monthly subscription. Excuse me. At Pathway, we do have a representative there who can give you a discount if you're interested, but I would say it's well worth the investment. Depending on the scale of your business, there are various subscriptions you can pay for. I think I may be misquoted, but I think the lowest monthly free fee is $12 or $15, but it's well worth it. Well worth it. Thank you so much, Ms. Smith. $12.95. Okay.
As SBDC clients, if you're a new client to QuickBook and you're an existing SBDC client, they provide a 30% discount for new QuickBook users, but there is a set of instructions that you have to follow. So feel free to register with us for that kind of assistance. QuickBooks has a wonderful blog and a really good video tutorial about running reports and things like that. And it's really just as simple as going to the reports and then clicking balance sheet or income statement. So it's
very user friendly.
Yeah, it's very user friendly. Xero is a beautiful, it's a beautiful competitor. They do wonderful. I mean, it's almost exactly the same features. It's just a different way of looking at it. So it's a slightly different presentation. Their user interface is really, really nice. Their starting prices generally are a little bit lower than QuickBooks, but they have more add-ons that you can pay for. So you can customize Xero, you can customize QuickBooks. More is built into QuickBooks, just the regular package that you buy, and QuickBooks is always offering discounts. So typically
That's very true.
First 6 months are $5.99, which puts it about the same price as Xero usually. Wave is free, Live Plan you pay for, Zoho you pay for, and I think Mint is free.
Thank you for that, Catherine. And I would like to say that QuickBooks is now introducing a cash flow forecasting tool, and Live Plan also has one. So Live Plan can connect directly into QuickBooks, and what we love about Live Plan is that you can generate and build your business plan there, and it has a section where if you have information into QuickBooks, your financial statements prepared, Live Plan will create projections for you, and you can go in and adjust your assumptions as needed. So thank you all so much. That's the end of my presentation. Here is my contact information, Jarlisi at Pathway WBC. That should be a dot, not comma, but .org. And then I'll pass it back to Catherine, who will talk about benchmarking. Thank you so much.
Okay, thanks everybody. Great questions, great chat so far. It really is much more fun when there's conversation going on, so that we know sort of where you are, because otherwise we're talking at ourselves. And I'm from New Jersey, so I like to talk, but just stop me. You got to stop me. Okay, so I'm going to start with assumptions, and then we're going to go into benchmarking. So being from New Jersey, sometimes we're a little bit ruder than folks in the South. So what we say is garbage in, garbage out, basically. If you're putting garbage into your cash flow assumptions and statements, then you're gonna make wrong decisions about what strategy you need to implement. So safe assumptions, where can we find safe assumptions? Trusted and widely used sources. Potentially, you can use information from customers, but you want to be careful that these are not just friends and family, because your friends and family, you're going to see them at Thanksgiving or on Zoom or across from the dinner tables. They're the ones who take care of you and protect your mental health as well as physical health sometimes. And so while they are excellent support networks, they don't always give us that critical feedback that we need to make those assumptions. And you want your assumptions to be very specific. Dangerous assumptions, so feelings and beliefs, generalizations, and anything that's not backed by data. Now, I run into this all the time where I'll be working with somebody who has 30 years experience in an industry, and they're like, I have this feeling in the pit of my stomach. And that's different than somebody who has 0 years experience in an industry, because that feeling is backed by 30 years of experience, right? So that is a safer assumption than something that is backed by 0 years of experience. It's still slightly dangerous. You want to be honest with yourself about that gut instinct, but at the same time, how valid is your gut instinct? So I'm not saying definitely include gut instincts or totally regard them, but just be very aware that there are risks of including them. And if your assumptions or if your gut instincts are based on a decade, 2 decades, 3 decades, 5 decades of experience, that's a safer assumption to make because you have that long history of active participation in the industry. So when we're thinking about benchmarking, we're thinking about very specific aspects. So we're thinking about specific timeframes, specific revenue ranges, and specific industries. We want to very specifically think about similar conditions, right? Something that is similar to right now. So in Jarlisia's examples, when we're looking back at numbers from 2019, we have to be very careful about that because there wasn't the same level of business disruption. And so those revenue projections may not be a safe benchmark to use exactly parallel, right? So we can take that 50% business off the top. Most industries right now are experiencing anywhere between 75 and 85% decrease over last year's revenue. So let's look at specialty retail store examples in the US. So this is from a report by IBIS World. It was done in 2020, I think in April. And so it really does take a look at where we are, where we're going. So it was adjusted given the recent circumstances. And so you can really see that revenue in e-commerce in 2020 are vastly different for specialty retail stores, right? So in 2019 and let's start in 2018, revenue from just regular revenue and e-commerce sales were pretty closely tied together. In 2019, we started to see that gap widen, and in 2020, it's pretty far apart, right? Folks are ordering more online than they are going in person. And yet, those total revenue numbers have still dropped pretty significantly. Industry performance overall, right? This is just kind of a regular revenue number. The revenue number has decreased somewhere between 15 and 18%. That is a huge change. And this is specialty retail stores in the US. So when we look at market segmentation, when we think about, okay, who can we approach as our next customer segment? What can we use as, who have we been selling to and who can we pivot to potentially to generate those extra sales? So if we're an ice cream shop and our main source of revenue is during the summertime, maybe we add a series of hot chocolates to draw in the winter crowd, right? To smooth out that seasonality. Maybe we pivot to serving a different customer segment. So serving customers 45 to 64 instead of 24 and younger. Okay, and then here is a really good place, here is a really good place to start. It's the cost structure benchmark. And so we're comparing the industry to the sector. Now, again, this is for total US. So I don't know, I wouldn't necessarily use these numbers exactly for benchmarking in your particular business, but they are a good reference point to start with. So in the sector of service and product businesses, we can think of, we can look at how the specialty retail stores in the US have a higher percentage of their costs dedicated to wages. They have a large percentage of their costs dedicated to purchases. Profit is a pretty decent size. Depreciation, marketing in yellow, rent is a good size, right? So when we're thinking about, okay, how do we increase our profit margins? How do we sustain our business through the next difficult couple months, the next difficult couple years potentially? We want to think about how can we decrease costs? Can we increase prices? Because decreasing costs and increasing prices are the quickest way to increase your profits. Every additional sale involves additional costs. And so with that fixed versus variable cost that we were talking about before, those operating expenses, those COGS, the cost of goods and services sold, if it takes you 50 cents to make every additional cookie and you're selling 1,000 cookies, that's going to be additional costs associated with that. The quickest way to increase your profits are by decreasing your costs, maybe not with the actual cookie ingredients, if that's where your competitive advantage is, but maybe you can pivot to online sales and move out of your brick and mortar store, something like that. So you can use these costs to say, okay, are my purchases in line with my industry? Am I spending too much on purchases, on rent, on utilities? How can I become more competitive and in line with the industry standards? So that is where I'm going to stop my presentation. We are about 5 minutes from the end of today's session. We covered so much information, folks, and really the point is just to introduce these topics, to give you a snapshot of what available information there is, what resources you have, what resources we have to help you develop your cash flow benchmarking, to think through your assumptions. And I do encourage you to talk to other people, especially professionals like accountants, about the assumptions that you're making, because it's easier for somebody else to spot an assumption that may not be as strong as you think. And we don't want to put garbage in because then we will get garbage out. So with that, any questions that we've got, I'd love to answer your questions, and we can kind of wrap things up for the day. So if you've got any questions, feel free to unmute yourself or just drop them right in the chat. And I will leave my contact information up there. Thank you so much for the kind words. Jerlicia, do you have any final thoughts?
Thank you so much for your presentation, Catherine, and just going over benchmarking, how it's so important to use that data and to use good quality data. I would just emphasize that also with your financial statements as well, just making sure that you have good data there. So thank you all so much for participating. Catherine and I will both be back for additional courses, and we definitely encourage you all to tune in. Let's see, someone mentioned, can't wait for the Mary Alice, looking forward to the QuickBooks deep dive. Mary Alice, QuickBooks is my jam. I love to teach it. Hopefully I'll see you there. Make sure you bring your questions, invite your fellow entrepreneurs, people that are in the startup phase, thinking about business. We're going to make accounting fun. So thank you all for joining us today.
So Robert mentioned to everyone, so we're going to be sending out the slides from today's presentation, and then we are planning on doing a second round of almost all of these trainings, if not all of these trainings, in the fall. So if you or a friend missed these trainings, if you'd like to revisit these topics, honestly, this is the foundation of good business growth. And even if you'd never master things like the ratios or, you know, more advanced financial things, if you have a solid understanding of the basics of what the difference between your profit and loss and balance sheets are, how to use them strategically in your business, I mean, even if you never get to that point of running, this is a solid walk. You are learning how to walk on your financial feet with these statements. So with that, I'm going to call it the end of today. Thank you all so much for attending. Thank you for your comments and input. Again, please, please, please reach out to us. This is what our organizations are for. We're here to help you. Thanks, everybody. Have a good one.